Hello and welcome to the Forma Models software as a service monthly business plan with return calculations. This model can be used to prepare and analyze a startup or existing software as a service (SaaS) business plan forecast that incorporates a pre-sale launch period, regardless of industry, using a three-statement model and key industry agnostic metrics. The monthly Pro Forma tab includes all assumption inputs as well as the calculations for the income statement, balance sheet, and statement of cash flows. The model is dynamic for up to a 5-year forecast period and allows for a variety of debt and equity assumptions, including the ability to buy back or issue debt and equity throughout the business hold period. The Output tab provides print-ready formatted reports of key metrics and indicators, which can be used with investors and lenders as an investment and business plan supplement. The README tab states the model purpose, highlights common use cases, and provides an overview of functionality, formatting, and all of the unique modules within the model. This tab also provides additional documentation, contact information, and a summary of additional products and services available from Forma Models to support your analysis needs. The General Assumptions section has 3 date inputs. The first date input is for the landing page launch. The second date input is for the pre-sales launch. This is to be used if you are planning a pre-sale period before fully launching operations and order fulfillment. The third and final date input is for the operating launch, which is the start date of full business operations. The Partnership Assumptions section contains inputs for up to 5 common equity partners. Pro rata ownership percentage inputs by partner are input as the assumptions. The Startup Valuation Assumptions is pre-formatted for 2 equity rounds, one for the pre-launch valuation and capital call, and one for the operating launch valuation and capital call. The pre-launch valuation is equal to the capital required for landing page hosting, marketing, and other overhead costs. The operating launch valuation is a larger financing round that incorporates capital expenses, working capital, and financing for current assets. A loan-to-value input is available for both financing rounds to calculate the equity and debt funding. This model is robust and pre-programmed for the use of long-term debt as well as a line of credit to cover operating shortfalls. The next section contains the Exit Valuation Assumptions inputs, including the earnings before interest, taxes, depreciation, and amortization exit multiple, as well as an estimate of closing costs as a percentage of the disposition value. The revenue forecast within this financial model is specifically built for mobile app and software businesses. The revenue forecast is generated based on the number of subscribers multiplied by the base cost for subscription, additional app upgrade revenue, as well as advertising income. This model applies for the large majority of mobile app and software businesses. If you require a different revenue model, please reach out to Forma Models for assistance, as we have a variety of pre-built forecasts available and take on custom model building engagements. Cost of goods sold assumptions are input next. The base model contains cost of goods sold inputs for base unit sales, upgrades, as well as other income, allowing for customized gross profit margins. Payroll expenses can make up a substantial portion of operating expenses. Due to their large expense burden, corporations at times will employ dynamic staffing models with staff working seasonally or only hiring people once certain metrics, such as a sales or profit target, are met. The Forma Models business plan has a complex and dynamic payroll module allowing for a variety of different staffing programs. The position name is entered in column B. The start date of employment is entered in column C. The number entered in the column relates to the model month number. For example, month 1 will be the first month of the model and month 12 will be the 12th month of the model. If you want a position's employment to begin in the first month of the forecast, enter 1 as the start month. The end date of employment for model purposes is entered in column D. Similar to the start month, the end month relates to the model month number. For example, if you want to model an employee for the entire 5-year analysis period, enter the end month as 60. If you wanted to hire a position for a project in year 3, but won't need the position beyond year 3, you can enter the start month as 25 and the end month as 36. Payroll burden is for overhead related to payroll expenses, such as payroll taxes and benefits. The payroll burden figure is entered in cell F30. An annual payroll inflation assumption is entered in F31 to account for annual labor expense growth. If applicable, vehicle expenses are entered next following the same format as the payroll schedule. If vehicle expenses are not applicable to your business, please skip this section of assumptions. Facility expense assumptions are entered next, which include rent, property tax, property insurance, utilities, as well as repairs and maintenance expenses. The final section of assumptions before we complete the income statement inputs is for selling, general, and administrative costs. This section contains inputs for typical selling, general, and administrative expenses such as insurance, advertising, information technology, and bad debt expense. Following the format of previous expense sections, an annual selling, general, and administrative expense inflation factor input is also included. With these assumptions completed, the income statement will begin populating in a neatly organized and logical format. Cost of goods sold are deducted from revenue to calculate the gross profit and gross profit margin. Gross profit is followed by operating expenses. You may notice that owner compensation, including salaries, benefits, and vehicle allowance, are isolated. Total operating expenses are consolidated and then deducted from gross profit to generate the monthly earnings before interest, taxes, depreciation, and amortization. The monthly earnings before interest, taxes, depreciation, and amortization is complemented by a calculation of the monthly earnings before interest, taxes, depreciation, and amortization margin. The earnings before interest, taxes, depreciation, and amortization is followed by depreciation and amortization deductions. Depreciation expenses are deducted to calculate the monthly earnings before interest and taxes. A calculation of the earnings before interest and taxes margin is also included within the income statement. Interest expenses are separated by term debt and line of credit and deducted from the earnings before interest and taxes to determine the earnings before taxes. Taxes are then deducted to determine the monthly net earnings and net margin. The days of sales outstanding, used to calculate accounts receivables, and the days of payables outstanding, used to calculate accounts payable are entered next. These are key inputs that impact the balance sheet as well as working capital, which impacts the statement of cash flows. The next section of the model calculates and summarized the monthly depreciation expense for capital assets. The depreciable asset schedule handles inputs as the item label in column B, the date of acquisition in column C, the expense in column D, the number of months to depreciate the expense over in column E. The columns to the right calculate the monthly depreciation by item depending on the applicable months of depreciation you input for the specific item. At this stage in the modeling process, the balance sheet will begin to populate. Please note that Pro Forma Models never utilizes plugs within our financial models. This means that all items flow through each of the three statements through the use of supporting schedules rather than utilizing accounts to force balance the statements. This leads to enhanced accuracy and credibility. The balance sheet models assets split into current and non-current assets. Liabilities are also modeled as current and non-current liabilities and includes any applicable debt used as part of the transaction you are analyzing. The balance sheet concludes with the equity accounts. Following the accounting equation that assets need to be equal to liabilities plus shareholders' equity, a check is worked into the balance sheet to ensure the accounting equation holds true. The next section of the model includes the debt calculations. The first section of debt calculation is for the line of credit debt schedule. The line of credit debt calculation begins with inputs for the percentage of receivables and payables that you will finance with the line of credit. The next input is for the minimum liquidity, also known as the minimum cash balance, that you want to maintain each month. The final three inputs relate to the interest rate and include the base rate, spread, and an annual escalator or reduction in the rate. Please observe that the dynamic line of credit funding calculation looks at the cash shortfall and draws down on the line of credit to maintain the minimum required liquidity. The line of credit balance will continue to increase as long as a cash shortfall is present. The line of credit formula will pay down the credit line with any positive excess cash flow beyond the minimum liquidity parameter. The turn debt is modeled next. The funding request is pre-programmed as the amount of capital expenses, working capital, and startup expenses financed by debt. The monthly principal payment amount sets the amount of debt principal to be paid down monthly. There is a monthly input available for additional principal payment if you want to accelerate debt reduction within the business. Similar to the line of credit interest rate assumptions, there are inputs for the benchmark interest rate, spread, and annual interest rate escalator or reducer. A cash flow statement is presented next, which begins with a calculation of the monthly changes in net working capital. The cash flow statement is organized in an industry-standard format with cash flows broken out by operating, investing, and financing activities. The cash flow statement concludes with a calculation of the monthly incremental cash flow as well as the monthly beginning and ending cash balance. This is incredibly useful for risk management, understanding run rate, and the ability to invest further in the business or pay down debt. Key metrics from the income statement and balance sheet are presented on a monthly basis. Key metrics from the income statement include the earnings before interest, taxes, depreciation, and amortization margin, net income margin, effective tax rate, and interest coverage ratio. Balance sheet metrics include the working capital balance, current ratio, quick ratio, debt to equity, debt to assets, and return on equity. The gross levered returns are presented next, including the calculation of monthly net cash flow, yield, internal rate of return, and multiple of capital. The Output tab contains a preformatted executive summary to visualize your business plan analysis. The first visualization shows average net annual revenue per subscriber by year on the primary axis as a bar chart and annual subscriber growth in terms of the number of subscribers on the secondary axis as a line chart. The output report continues with a tracking of annual revenue, cost of goods sold, as well as gross profit in a mixed bar and line chart. This chart is neighbored by a visualization of annual revenue and revenue growth. These are important exhibits for equity and debt investors that want to see how the business will grow once operational and approaches a stabilized subscriber base. Thank you for tuning in. We hope you enjoyed this Pro Forma Models walkthrough and encourage you to visit our website to try the model for yourself.